Hi guys, my name is Nicolette Mashile. I am also known as the Financial Bunny. Welcome to the Financial Bunny TV. Today we're talking all things the nature of the relationship between risk and return. Now do remember that none of my videos constitute as financial advice. If you are looking for financial advice, please do speak to somebody that is certified and registered with the FSCA to give you financial advice. This video is brought in partnership with OctaFX. Now OctaFX is an international forex trading broker. They really want us to get into this conversation to try and simplify finance as much as we can. So let's talk a little bit about it, right? You'll hear a lot of people say high risk, high return. But I'd like to position a different approach totally and say high risk, high potential return. And the reason for this is because we need to understand the relationship that exists between risk and return. And perhaps let's start off with doing this. Have you ever, let's say, for instance, and I always talk about this, my favorite thing to talk about is predictability, right? And creating what is called predictability within your finances. And when I speak about predictability, I always use the example of a tree. If you, for instance, take an apple seed and you put it into the ground, you are hoping that one day you're going to have an apple tree that is going to bear apple fruit, right? So you put it into the ground, you put manure, you put all of the things that you think are necessary to be able to create a conducive environment for your apple tree to actually go. And then what you're going to do is you're going to water it and you're going to take care of this apple tree up until to the point where it actually gives you the result that you are expecting, right? And that is what we call expectation, right? But if that apple tree does not grow, or for instance it does grow but it does not give you apples, or it gives you a different fruit altogether, there is a distortion between what you expected and what you've actually received. And that's when we talk about this concept of investor expectation and reality. And that's where you actually start to see the relationship that exists between risk and return. Because if you look at the financial world, the word risk basically talks to the exposure, the extremity, the severity at which there may potentially be a loss that you could experience due to the exposure of where you're going to be putting your money. So for instance, we'll talk about different asset classes and we'll say things like the stock market is far more volatile than the bond market. Or we'll even say forex trading, because it's a huge $1 trillion market, it's far more volatile than the cash market. So if you're putting your money into cash where you're going to be earning interest, it is far better in terms of risk profiling than if you are trading forex. And the reason for this is because if you trade forex, the chances of you losing may just be higher than if you're putting your money into an interest-bearing account where they tell you you're going to receive 7% back from the market. The chances of you losing that money in that account is far less than if you had traded the same money within forex. So basically what we're saying here is that there is a relationship that exists, that the higher the risk that you're taking, the higher the chances that your incentive may just also be as attractive as the actual risk. I hope that is making sense. So basically, when somebody is willing to take the risk, we expect the incentive or the result to be just as big as the risk that they are actually taking. And that is the nature of the relationship between risk and return. We're saying if you're going to take that big risk, then the result should be incentivized. But it is not guaranteed that if you do take that risk, there is going to be a higher return that you are going to be receiving. So then what type of risk trade-off should an investor or a trader actually take? Well, that is dependent on you as a person. One, it is dependent on your risk profile. Not all of us have the same type of risk appetite. And also the life stage that you are in may also determine the type of risk that you're willing to take. The second thing is the money that you do have to be able to put into a risky space may also determine how much risk you are willing to take. Now, I'll give you an example. If you are, for instance, using your last 5,000 Rand in your disposable income and you want to put it into a risky venture, one thing you've got to keep in mind is that there is potential to lose that entire 5,000 Rand. That could, in its nature, change where you want to put your money. You could say, actually, because it's my last 5,000 Rand, I want to put it into maybe a more conservative type of investment or trading a platform or trading a deal or position, simply because you don't want to take the risk of losing the entire 5,000 Rand, right? Also, as I said, the life stage that you're in, if you are closer to retirement, you may not have the luxury of going for a more aggressive type of approach when it comes to your trading or your investing. So you're not going to go to the higher risk investment strategies or investment asset classes or the trading positions that are far more riskier, because you want to preserve that money so that you have access to it during your retirement years. So your risk appetite may change with your life stages. It may also change with your personality. There are people that are just not risky or are not willing to take a risk when it comes to their money in terms of things like investing or trading, but you may find that there are other places in their life where they are willing to take a big risk. So it also depends on the nature of who you actually are. What is your investor profile? What is your investor ID? That will tell you the type of risk that you are also willing to take. But I think also the third thing is the possibility or the potential to replace any of your lost funds. That is also important, because you may potentially, for instance, right now we talk about the stock market being in a bear market, right? So when a stock market is in a bear market, generally the guidance is that it's lost 20% of its value in terms of share prices throughout your different stocks, right? Now, the reality is, when we speak about the stock market, we do say the stock market is of a higher risk, right? So if you are going to go invest into the stock market, generally you are expecting some level of volatility within that market. Now that you have lost, a certain percentage of valuation of your investment portfolio within the stock market, what is the potential for you to be able to replace those funds or that valuation within your actual portfolio? So that's also something that one needs to look at if they look at the trade-off between risk and return. Overall, this said risk and return trade-off is going to also count at a portfolio level in terms of where are your investments actually sitting. And this is why we bring in the old adage of don't have all of your eggs in one basket. The reason we say this is because, let's say, for instance, you have an investment portfolio that just only consists of equity. Right now, the equity market is going through a bit of a struggle. For instance, maybe you had all of your money within the cryptocurrency space. And we've seen that cryptocurrencies are also taking a beating right now. So because of that, you then need to balance out the risk within your portfolio. So that's when we start talking about things like asset allocation. If you have 1,000 Rand to invest or trade every single month, how are you going to allocate this 1,000 Rand to various different asset classes and investment vehicles or financial instruments that are available at your disposal that do not give you exposure to just a high risk? So you've got to balance out. You've got to say, with your 1,000 Rand, I'm putting maybe 30% into something high risk, 30% into something conservative, and maybe your 30% into something else. I know that doesn't equal 100%, but you've got to look at how much are you willing to put into what levels of risk when it comes to how you actually invest or even how you actually trade.